Good morning, everyone. Welcome to the third part of our three-part seminar, Exposing the Myth of Retirement Investment. And Mr. Emerson Hartzler will lead the way. Mr. Hartzler, the screen is all yours.
Thank you, Alina. I will try to share the screen and get this presentation underway. So this session is going to concentrate on a potpourri of subjects and end in talking about a withdrawal rate. And we're going to start with that and come back to it later. So if you're working with a certified financial planner, someone putting together a plan, that financial plan should target a percentage annual withdrawal rate. And we'll talk a little bit more about that later. And of course, this it requires a lot of discipline. And the discipline is selling only enough shares to provide the dollars needed in the financial plan. And it requires an absolute commitment not to sell for any other reason. So as I said a number of times already, we as individual investors cannot control market prices. And we can control the number of shares we own. If we can avoid selling during a bear market, when the market is down, we'll have all of those shares and more if dividends are reinvested to participate in the price increases in the next bull market. However, since retiring in 2007, I have needed to regularly withdraw invested funds to support my decadent lifestyle. So at the end of the presentation, we will look at the detailed analysis of just how much can be withdrawn from investment accounts each year and still have sufficient shares to play when that next bull market comes. Suffice it to say at this point that your withdrawal methodology must be highly disciplined. Your financial plan should include a maximum rate of withdrawal that will limit the number of shares you sell each year to support your planned lifestyle. The discipline comes in ignoring the ups and downs of the bull and bear markets, sticking to the plan of only selling enough shares each year to provide the dollars needed in your financial plan. So selling for any other reason is verboten. You may be tempted to think things like, well, the market seems to be overpriced today. I think I'll sell and take the gain. Or the market is falling like a rock. I think I should get out while the getting is good. Or I just saw the new Tesla, but I have to have one, but my bank account is overdrawn. Well, the answers to those three questions are no, no, and no. So that's the discipline commitment. I want to spend a little time on this because I've talked about using a certified financial planner or a CFP on a number of occasions. And I want to really get a little bit more in detail of that. So I spent the last 16 years of my career trying to manage the business affairs of a group of 40 cardiologists. And that's been described as similar to herding cats, but I was very fortunate and privileged to work with some very intelligent cats. Anyway, every doctor was required to have his or her personal physician, and that requirement could not be satisfied by looking in the mirror. Physician, heal thyself was not a motto we used. Every physician had to have their own physician. The same is true in the professional investment advisory space. The group of certified financial planners I use requires each of their advisors to have their own personal financial advisor. And as with doctors, that requirement cannot be fulfilled by looking in the mirror. So if CFPs, the experts in this industry, need a personal financial advisor, how about you and me? Well, you better believe it. None of us is exempt from greed and fear, the two human emotions that threaten to wreck any investment strategy. A good CFP will repeatedly conduct fire drills, reminding you that the market will tank at some point in the future. If it is not if, it's when. So what will we do when this happens? Repeat after me. We will stay the course, stick to the financial plan, ignore the dollar value, count the shares owned, and honor the plan withdrawal rate. So that's, you just need to repeat that over and over. So there's a host of financial advisors out there. So you need to check credentials. The certified financial planner, the CFP, is the industry's highest designation. In addition to competency, the CFP is required by regulation to always act in the best interest of the client, and the penalties for not doing so are severe. There are many seemingly good products. We'll talk about one of those later, annuities, available to financial advisors, and some of them offer lucrative incentives to the advisor, but they may not be the best answer for the client. I think the old adage, the good is the worst enemy of the best, applies here. Your financial advisor should be recommending what is best for you and accepting a good reward for doing so, not the other way around. So I recommend you work with a CFP. So a good CFP will continually analyze all aspects of your financial situation. Things like basic budgeting for your lifestyle, saving, investing, giving, risk management, the insurance products you should have or should not, financial estate planning and tax planning, just to name a few. And typically, a CFP will charge about 1% annually of your investment balance up to like $1 million or so. And above that, if you have more than that, everything is negotiable, basically. So that's my spiel. I think I have a financial CFP that works with me, and doctors need doctors, CFPs need CFPs. It's someone else that's independent and will take the emotion out of your decisions. Now, I would be remiss if I didn't talk a little bit about annuities, and this is a fascinating subject to me. A lot of people my age own these, and I've looked at a number of these. I'm not an expert, but I have been able to look through a number of these contracts, and they're generally very complex. And they're sold on the basis of the pros that I will give you a guaranteed predictable income. And that's the basic selling point. And to back up a little bit, I'll talk about when did these annuities really start to blossom? Back in the generation before mine, you went to work for a company. My wife's family all grew up in the Argentine district of Kansas City, Kansas. A lot of people worked for the Santa Fe Railroad. It was a great job, a great company. They would sign on at some early age, out of college, out of high school, whatever. They'd work for the company all their life. Then they would retire and they would get what's called a defined benefit plan. The company, through all those years, was putting money aside, hopefully. And then when they retired, they got a defined benefit, X dollars a month. If you're a teacher or works a not-for-profit, you may have a defined benefit plan like Capers or police and fire. But by the time I came around in the workforce in the middle to late 60s, things like Enron were happening. If you remember that was a defined benefit plan guaranteed by the company. Unfortunately, the value in that plan was mostly in Enron stock. Enron went bankrupt. You had a whole bunch of people that thought they were going to get a benefit and they were out in the cold, a very tragic situation. So about the time I started working, most of the corporate entities said, we've got responsibility for this benefit plan and we've got all these liabilities. We really don't like that. And so now we saw the switch to IRAs, to 401ks, to 403b plans. And there you see a defined contribution plan. So you have defined benefit, you're going to work for a company for a long period of time, you're going to retire, they're going to pay you a monthly benefit, and that benefit is defined for the rest of your life. Sweetheart deal, okay? Well, now the companies were saying, yeah, let's go to a 401k or a 403b, and we'll define the contribution. So you can contribute whatever you want of your own money. We'll match it perhaps up to a certain level, and we'll put that into an account that it has your name on it, okay? Well, that's great. You bump along, and then you quit working for that company or you retire from that company, and they say, okay, now we have X dollars in this 401k, 403b. What do you want to do with it? Because we're getting rid of it. It's no longer our responsibility. You're no longer an employee. Come get your money. Well, at that point in time, a lot of people just freak out. They say, oh, wait a minute. I don't know how to manage money. I mean, it was always done for me before, and I'm afraid of the stock market. Maybe they have a financial advisor who recognizes that, you know, they are risk averse. They just don't have the education. And so I can imagine what happened in the 60s and 70s. People, especially the insurance companies, were sitting around a conference table trying to figure out, you know, how do we make money in the future? And some bright MBA like myself who thinks, you know, he knows everything about the world, later to find out that you don't, but would say, hey, here's an opportunity. We have all these people retiring with these defined contribution plans. Now they roll into IRA and they are responsible for managing it, and they're freaking out. So why don't we come up with a plan that kind of gets them back to the good old days where they have a defined benefit plan? We could do that. We've got the money. We could take that money, we could invest it, and then we could guarantee, and here's the key word, we could guarantee a predictable income just like the defined benefit plans did. We could return to the good old days so the person wouldn't have to worry about, you know, losing their money in the stock market. We as an advisor don't have to take the time to try to educate them like we're trying to do with this presentation. We can just sell them an annuity, and we'll just take the money, we'll invest it instead of them, and we'll guarantee this payment to them. I mean, what could be better? So, you know, it was a great idea. And then if we lock them in through surrender charges, okay, they're going to be there for a while. So if we do that, we can afford to pay a very handsome commission to the people who sell it. So they have a very strong sales incentive. And that's basically what happened. So you go to a financial advisor, you say, gee, I'm worried about this. I've got this big IRA. It's got a bunch of money in it, but I don't know how to manage it. I don't know anything about investments. I'm trapped in the prison of two ideas. I either trust somebody or figure out how to manage it myself. So, and then the advisor says, well, I can spend a lot of time trying to educate this person and get them to the point where they're comfortable with the stock market, et cetera, or I can just punt and say, you know, I'm going to sell you an annuity. And it's just a lot easier. And I get a really nice commission. Now, there are some reasons for buying an annuity other than the predictable income. Some annuities will guarantee some life insurance. So if you need life insurance and can't get it, it can be attached as a rider. So that's a benefit, and that could be applicable. Same thing with long-term care insurance, really hard to get today. Well, you might get that as a rider. So there's some benefits here. And I come on pretty strong against annuities, but there are occasions when there are a good product. The cons, of course, are many. The fees are ridiculous. The returns you get are lower than what you would get in the stock market. There's less flexibility. Once you sign up, there are surrender charges. If you want to get out of them in the near term, 8 to 10 years, it's going to cost you a lot of money. And they're highly complex. I've never seen any of these contracts that go less than 20, and some of them are 40 pages long. And so I think it's kind of easier to sell these annuities and educate the buyer. But if you look at the business plan behind this, what are these insurance companies or the people who sell these annuities, what are they thinking? Well, I'm going to take the money, I'm going to invest it, I'm going to get this 10% in the stock market like we've been talking about the last two sessions, and I'm going to guarantee some lesser amount to the guy who bought this annuity. And the difference will be a handsome profit for the company. So everybody's happy. Well, you remember this little rule of 72. Let me get back to that. Let me out. Maybe I will, maybe I won't. Sorry about this. There you go. So let's go back to the rule of 72. So if the insurance company says, okay, I'm going to make this 10%, I'm going to keep that myself. Now I'm going to I'm going to absorb these up and downs in the market. I understand the market. I've got the capital to get me through the bear markets and so forth. And I'm going to get this 10% return, and I'm going to give the annuity holder the 7.5. Okay, it's probably going to be something like that at most. And we said, well, okay, what difference does that make? Well, in the rule of 72, 10% return doubles every 7.2 years, 7.5, 9.6. And if your planning horizon is 30 years, that's 4 versus 3. And again, if you started with 500,000, you bought an annuity versus invested yourself, 30 years later, you got 8 million versus 4 million. Okay. So by buying the annuity, you're accepting the lower rate of return, and it could be a lot of money over time. So say, well, okay, we'll get a little bit less return, but it'll be safe. Well, you're giving up a monstrous amount of return if you're doing that. Well, it doesn't want to behave.
Mr. Hartzler,
Yes.
you can click on this little icon at the bottom right hand. No, not that one. No, yes. And usually it makes it go.
Well, let's just go with this then. I think you can read this. I'm having trouble.
That's good.
Apologize for this, but it's just, oh, here we go. Huh. It's not letting me do it. Crazy. Okay. All right. So I think that's big enough to see. Let's see. All right. So that's annuities. The next thing I wanted to talk about was investment statements. And one of the reasons I wanted to do this presentation was because I think a lot of people have a financial advisor and they get investment statements. I don't know how many people have come to me and said, can you look at my investment statement because I can't understand it. And I look at it and say, well, I can't either because it's got multiple pages. There's a lot of data, but no real information. And so I want people to look at their investment statements and have the information they need. And so this is, if you're going to take notes, this would be a good time to take it. Or if you want a copy of the presentation, let me know, because I think this is something you should have at your beck and call. 4 things that every investor should know, and most don't. Number 1, is the investment strategy recommended in line with the Buffett recommendations? Remember, we talked about low cost, index mutual funds that are highly diversified. And again, most of my friends that I talk to do not have an investment strategy that lines up with that. So that's the overall arching thing that you should know. Then secondly, what is the total amount I am paying for all this investment management, dollars and cents and percentage of investment balance? So if you have mutual funds, there's a charge to manage those mutual funds. That's in that statement. You don't write checks, it just comes out of your balance. And a lot of people don't know what that is. And it could be 1%, 2, or even 3% alone. So then you've got your financial planner who's charging you a fee. That should be made known to you. But if you add it all up, what are the total dollars that I'm paying, both in terms of dollars and the percentage of my investment balance. And I would say that if you're following Buffett's recommendation using a CFP, you should have something in the neighborhood of 1.25 to 1.3% per year total cost. So that would be what I would consider a reasonable rate for managing. And then the third one is, what has been my average annual rate of return since the current investment strategy was put into place? Now, we've talked about the stock market returning a little over 10% on average per year for the last 93 years. Well, you're going to have some expenses. If it's 1.25, maybe you end up with a net of 9% average rate of return. And again, any one year could be minus 35, plus 45, or anything in between. But you need to know every year what has been the return. And then since the current investment strategy was put into place, what has it been? I'm looking at a 10-year, a 20-year, a 30-year rate of return. That's what I'm really interested in. And then when I know that, then the fourth thing we need to benchmark. So some people come to me and say, well, last year I got 12% rate of return. I'm really happy with that. And my next question is, well, what should you have gotten? What's your benchmark? I mean, what did the market do? And if the market did 12%, then you should be pretty happy. But if the market on average, made 20% and you got 12, then the 12 doesn't look so good anymore. So what's the benchmark? What did the market do? And you should be benchmarking against the overall market return, because that's what you're trying to get. So those four things ought to be available to you. And I'll give you a sample of an investment statement, if I can get this thing to, there you go. So I know what my charges are because I get reported, those charges are reported by financial advisors. So I know to the dollar what I'm paying every year. My returns come through my statements. Wrong one. So I have several accounts. This happens to be my wife's IRA. I wish I just had one, but the government says, no, these are individual accounts. So we have a Roth IRA, we have my IRA and my wife's IRA. So this illustrates, I think I took this this morning. Anyway, market value is $125,000. And if you'll see, 99% of it is invested in equities and has a little cash going along. So that's kind of basically my investment philosophy. So that's one page of the statement. The next page of the statement tells me my returns. So it says, okay, this is an individual account for the period, and this is for the first 2.5 months of 2022. My rate of return is minus 6%. Do I care? Not really. I don't care what happens in 3 months. Now, the last 3 years, it's averaged 12%. That sounds really good. It's more than 10. Do I care? Well, kind of. And then this is about 9 years, 8 or 9 years since this performance reporting was put into place. I'm averaging 11.96. Well, that happens to be a pretty good time in the market. So I'm going to be looking at this number ongoing. And I'd like to see every year, at the end of the year, you look at the statement and it'll tell you what it was for the year, what it was for 3 years, and what it was since the inception of this investment strategy. But that still hasn't answered the question of, well, is that good or bad? And there's some benchmarks here that come out of the standard reporting. The one I look at is the MSCI, which is an all-world index. This is basically what the entire market did worldwide. And again, about 60% of the stock market available to you is US based, 40% outside. So that's what I use for my benchmark. This measures the rate of return. Well, so far this year, the entire stock market by this index has gone down 6.78%. So I say, I'm enjoying the same pain as everybody else is. Over a 3-year period, I've gotten 12% per year. that index has returned 12.78%. So I'm a little bit below. Does that concern me? Not really. I'm in the ballpark. Since inception, 11.96, the average is 10.77. Okay, so I'm right in line. So now I've answered the question. I know what my costs are because I get the report from my advisor. What has been my return? Well, I know it's 11.96 since we started reporting here. And is that good or bad? Well, it compares with the market. I'm getting market returns and I'm happy. And getting this kind of information is apparently very difficult for most people. It's really difficult to get in many cases. Just isn't going to work for me. So again, 4 things you ought to know. Is the investment strategy recommended in line with Buffett's recommendations? What's the total amount I'm paying for all this investment management dollars and cents, and the percentage of the investment balance? What's been my average annual rate of return since the current investment strategy has been put in place? And what has been the benchmark rate of return? What's the market done? Am I in line with that? So to summarize this whole presentation so far, Warren Buffett is suggesting that you need to invest in low-cost, diversified index mutual funds. The low-cost 1.25 to 1.3% per year for all costs is what I would consider low cost using a CFP. Diversified, we talked about that. I own 10,000 companies through 3 mutual funds. Owning the whole market assures you of getting that 10% of those companies that will really do well every year. An index mutual fund is where you get the low cost and high diversification. So that's overall strategy. Again, you need to mitigate all investment risk. You need to mitigate business risk by owning a lot of companies. That's diversification. You need to limit the systemic risk by limiting the number of shares that you sell, regardless of what the price is. And then inflation is the real risk that I worry about. And you mitigate that by buying stocks rather than safe investments like bonds. Thirdly, engage a CFP to help manage greed and fear. Everybody needs one, even a CFP. And then develop a financial plan with a disciplined withdrawal rate. We'll talk more about that later. And then hold your CFP accountable. I want you to have a trusted advisor, but I want you to have the information to hold them accountable. And that's these 4 things here. So I have one kind of fun chart here that has nothing to do with the presentation, but I couldn't resist giving because it's such an upward positive thing. You say, well, why should you invest in stocks? And if you think about it, what you're buying ownership in companies that make things, produce, give services or manufacture things and services, products. So why is that a good deal? Well, what's happening in the world, despite certain setbacks like we see now in the East Europe, things are getting better. The number of people, the 7 billion, that are starting to be able to buy stuff is remarkable. So this is a chart of what's happened in the last 200 years, and it illustrates the world as 100 people. So if you take 100 people, how many of them 200 years ago were in extreme poverty? Okay, 94 people out of 100 in 1820 would have been living in what we would call extreme poverty today. 6 not. So there was a lot of poverty 200 years ago. If you follow this graph, this ends at 2015. Now we have 10% or 10 out of 100 people living in extreme poverty, and 90 out of poverty. Now 10 living in extreme poverty is a problem. That's a lot of people 10% of 7 billion people is a lot of people. So we aren't done with problems. But if you think about this curve, how many people now can afford to buy stuff, middle class and so forth, it is amazing. And that's what drives our world economy. And that's what I say. I invest in stocks. I own companies, little pieces of them. They're going to make things and provide services to people who now can afford to buy them. Basic education, 83 out of 100 back 200 years ago had not in any formal education. Now we have 14%, still a problem, but 86% have a basic education. Literacy, back 88% weren't able to read 200 years ago. Now only 15 out of 100 are unable to read. Still high, but we've gone to 85%. You look at democracies, vaccination, child mortality. I mean, we live in a wonderful world compared with what it was 200 years ago. So, and again, I think the future is bright. Okay, so now to the last part of the presentation. I want to talk about withdrawal rates. So as I said, I retired in 2007. Which was a terrible time to retire. And so I was sitting around working with a group of CFPs. They had all this data, and I'm kind of a data guy, okay? And so I said, well, you know, should I be worried about my retirement funds because I'm now sitting 18 months into retirement and I have about a little over half of what I thought I had to start with. I said, okay, I better look at this stuff pretty carefully. And so I said, okay, what I will do is I'll look at all the data available and I'll see, okay, what if I had a withdrawal rate of 6%? My overall strategy before I got all this data was to say, okay, I'm gonna invest in stocks in my retirement year. I'm gonna make 10% plus, because that's what the market has always given us on average. I'm going to pay some fees for a financial advisor and so forth. So maybe I get 9% rate of return on average, net of expenses. Inflation's going up by 3%. So if I want to keep up with inflation, I've got to withdraw less than I'm earning. So, okay, I can draw 6%. So I make 10% in the market, I pay fees, my net is 9%. Inflation is 3%. If I want to keep up with that, I can safely withdraw 6%. Well, the CFP says, well, that's interesting, but it's kind of naive because, you know, you have these ups and downs in the market. So how do you know if you can withdraw 6% every year and index it by inflation? How do you know you can actually get through these bear markets? And I said, well, that's a great question, and I don't know. So I started digging into the data. And this is an Excel spreadsheet, and it goes on forever. I'll try to pick and choose what I show to you. But my theory was, okay, well, let me look at history over my lifetime, and let me identify what were the worst times to retire. And as it turns out, 2007 wasn't the worst time in my lifetime. The year 2000 was, but 2007 was the second worst. And there was another one that wasn't very good. So I looked at about, I think, let me see. Yeah, I looked at 48 years of the stock market. And I picked out the 3 or 4 worst years when the stock market really went down. And I asked the question, would I have survived those years in history with this 6% withdrawal rate? If I could survive the 3 worst years out of 48, then if I had picked any other year out of the 48, I ought to be golden, right? So let's just test this thing in the worst case scenario with actual data in real life. This is what actually happened. So I drew up this simple model. I assumed a beginning balance of $1 million simply because it's a round number and it's easy to check the math because there's a lot of math in here. And I said, okay, I'm going to withdraw 6% every year. That's $60,000, and I'm going to index it for whatever inflation was. All right. So here I go. I start out in the worst case scenario. It turned out to be the year 2000 because the stock market went down, down, and down for 3 years. We talked about that earlier in the sheet and the graph. And it's this was a really, really bad time. So I start off with $1 million and I earn a negative return. And I withdraw not 60,000, but I withdraw 61,000 because inflation in 2000 was 3.4%. So what I end up with is $918,000. So I've lost a whole lot. The second year, my rate of return is -6 for my all stock portfolio. That's 57 minus in earnings. Inflation was more benign. So I withdraw 62 again, got to keep up with inflation. And now I'm down to 798. And after the third year, my $1 million has gone to 621. I'm really hurting. Well, 2003, 2004, 2000, they're all good years. And I start to come back. Okay. And so I would have come back here. So to my $1 million by 2006, 2007, looks like I'm in the upper, and then the financial crisis hits, -40. Okay. So now I'm back to 564, but I'm taking out, increasing amounts every year. And so by 2021, I got about a 21% rate of return. And so now I'm back to 584. I'm still not back to my $1 million, but I'm taking money out and I've survived. Who knows what's going to happen in the future? But again, this is the worst year to retire out of 48. So I'm still hanging on. I'm getting through it, but I've withdrawn $1.7 million in 22 years. So even in the worst case scenario, can I survive? Yes, I can. The second worst scenario was 2008. So this is the one that's near and dear to me. So using the same math, I start out with $1 million, 2008 -40. So my earnings were -405,000. Now the inflation rate's benign. I only withdraw 6,300. So my ending balance is 595. And this is near and dear because this is kind of what happened to me. Well, then there's plus years and minus years and so on and so forth. They go through, and by 2017, which was a pretty good year, I'm back to $1 million. Now a little bit problem here in 2018. And by the end of 2021, I would have been at $1.2 million. In the meantime, taking almost $1 million out. So this is the second worst case. The third worst case is 1973. And if you follow the numbers there, you get back to $1 million here by the sixth year. And then it just goes crazy. By 2020, you'd have 22 million bucks. Okay. So even the third worst case looks pretty good. Now, if you take, that was 1973, when you took this horrible hit. If you just waited a year to retire, and that's the value of financial planning, to say, okay, we might want to hedge our bets. What if we retired a year later? Well, 2 years later, you would have avoided these minus. In that case, 1975, the $1 million would have gone immediately to $1.4 million. Look at this. And so I stopped at 1990. It's ridiculous. I mean, you're going to the sky. So here's 1990 was our worst case, right? What if we just started a year later? 1991, I grow immediately 7 million. I mean, it's crazy. 1 year after the worst case, 2001 rather than 2000, still looks pretty good. So you can go, it goes on and on. Then I went back to the Great Depression just to have fun with this. And I said, okay, 1920 if we retired in 1929, what would have happened? Well, the stock market didn't go to zero. It went pretty bad here for a while, but still I would have survived for 12 years, even in the worst case. And if I started in 1926, the stock market went up a lot and then came back down. In that case, I would have survived and done quite well after 30 years. So even in the Great Depression, if I had started retired in 1926, I'd have been just fine. So that kind of answers the question. If I survived the three worst case scenarios, every other case is it just goes to the sky. And if you look at any of these cases and you say, okay, what if I had invested in long-term bonds here, 1975, retire, this grows to the sky, the bonds, here's what the bonds did, annual rate of return. And after 16 years, I would have 15 million bucks. I would have had 897,000 bonds. Here's the fourth worst case scenario. I'm about even with bonds. Any good case, any 45 out of 48 years retiring, I have an ending balance that's 3 times what bonds would give you. So safe investments here aren't really safe. Now you say, okay, well, that's 6%. That's pretty aggressive. Most financial advisors will say, 4% safe. The reason they say that is they're recommending 50% stocks, 50% bonds. And if you're only earning 7 or 7.5%, then taking 6% obviously isn't going to work. So if you play around with this thing, well, what could I really do? Let's take this worst case scenario. Would I survive at 7? I just plug 7 in here. And you'd last for 19 years. So even 7% there. Look at some of these other scenarios. My case where I retired in 2008, if I do 7%, well, I'm almost back after 14 years to the original $1 million. Let's push it. Let's go to 8%. What the heck? And I would still be down around here after 14 years. So it's survivable, but it gets to be kind of iffy. If I go to 10, then not going to work at all. Some of these good cases, though, would work. So if you retired in 1975, you took 10% out a year, no problem whatsoever. So again, this goes back to the value of planning. If you've got this and you adjust it on an annual basis, you're going to find when's the right time to retire, how much can I withdraw. But it is super sensitive. You go beyond a point, and you need to continue to grow that money if at all possible. So back to my particular scenario, this is what I've lived, been through these downturns, and that was ugly. That wasn't very pretty, but all in all, it's tracking pretty well at 6. If I went to 5, this thing turns around pretty nicely at 4%. Feeling really good about that. So there you go. It's a discipline. And the point I wanted to make with all of this, I picked the 3 worst case scenarios out of 48 years of investing, and the other 45 all look great. And stocks totally outperform bonds in those cases, and you can get through the ups and downs of the market. So this is the only real disciplined research I've ever done in my life, but pretty proud of this. So that's all I really had to offer this time. We have questions coming in.
Hi, hi, I have a question.
Yes.
So sorry, I came later because I came into work late, but I will re-listen to this. So you said when you retire, you are expected the return is 6%, you said, or 4%.
So this is the withdrawal rate. So I asked myself a question: what what rate of withdrawal do I need to manage my lifestyle? So I need to take some money out. I don't have the benefit plans and so forth that my ancestors had. Okay, so that's the question. How much can I withdraw? And if I set that rate and do it every year, and I'm very disciplined about it, what's going to happen to my investment balance? So the question is, how much can I withdraw? And that's
Yeah.
what this analysis says. And I started out with a 6% withdrawal rate.
But expected return, I guess expected return is 4%, right? If you are kind of not very risky, that's what mostly bonds would be 4% expected return, correct?
Right. Well, so this is a good example. If I retired in 2000 and I invested in bonds, this is what bonds actually returned over those next 21 years.
Mm-hmm.
And the average is going to be about 3 or 4%. Okay. So if I did that and took out 66%, okay, I would end up with an ending balance of 1.6 million. So I'm better off in bonds in this scenario.
Yeah.
But it's the worst case.
And
I look
if
at
you,
many others,
but if you don't spend, the mandatory withholdings you have to take after 69 and a half or 70,
right?
can you put it back in? Because last time you mentioned the Roth IRA.
Yeah, if I don't need the money, then sure, I can just transfer it over to the IRA. I don't need to take it out and spend it, right? So this is my calculation of what I need. I think I needed to withdraw 6% a year to support my lifestyle. Okay, that was, I have certain income, like Social Security and so forth, but my lifestyle is at a higher level. So how much do I need to withdraw? And when I retired, I said, I think I really need to take out 6%. Financial advisors are saying, it's pretty aggressive. So this is my test to say, can I do this and still survive? And the answer is yes, I could.
And also, if you have a portfolio, like let's say 700,000, how many? I have index mutual funds with Vanguard. How many is too many, and how few is too few? I mean, what is like? How many mutual funds is it? If you have index funds.
Well, you just need to have enough that you're highly diversified.
Well, when I took a finance class at KU, a cocky professor told us all you need is money market and total stock market index, because he said it contained, it was probably simplified. And of course, money markets were yielding much more than they yield now. But he said total stock market and money market.
Yeah, well, in today's world, if you're not into stocks, you're not going to make enough money. You're going to withdraw. Whatever you withdraw is going to be withdrawing from your balance, and it's just going to go down.
Right,
okay?
right.
So that's not a good plan. So you could put any number in here you want to put in. If you have 700,000, then at 6%, you're going to be able to withdraw 42,000 a year to support your lifestyle. So then you have to look at your plan and say, okay, is that going to balance my budget over a period of time? And so,
well, my question was, how many mutual funds should one own? I guess, if like,
I would say enough mutual funds so that you had tens of thousands of companies represented. So I've got 10,000 companies. Is that a magic number? Not really, but you need to have more than just a few hundred. You need to have thousands of companies represented.
Well, the total stock market, how many does it have? It
depends on what your mutual fund is.
Well, total stock market index, I don't know how many. It has a lot of companies.
It should tell you that. Vanguard has a total world index fund that I think has about 9,500 companies in one fund.
Yeah.
So if you have something like that, you could cover the. I have three mutual funds that I use that are index type funds. They call them market-based funds. and they total just over 10,000 companies.
Mm-hmm.
That's the
Mhm.
kind of diversification I would recommend. So
Mhm.
however many it takes, if you can find one that mimics the whole world, then that's good. I need to do some more research on Vanguard is a good
Mhm.
index company. They specialize in index funds, and they have a number of them, but I would say just make sure you have thousands of companies represented to
Mhm.
get the diversification.
Well,
You
thank
can
you
plug
very
in the
much.
numbers you want into this, and if anybody wants a copy of this, they can email and I'll send it to you and you can play around with it. It's
Mm.
kind of cool, but
Well,
I
thank you
just started
very
out,
much. Mhm.
I just started out with $1 million because it's easy to check the mathematics around.
Yeah.
So
Yeah. Thank you.
you're welcome. And again, let's go back to the slideshow here. Yeah, so if you have questions and after this, or if you're looking at the video, you want to contact me, that's my email address. Give me an email. I'll give you a copy of the presentation, a copy of the Excel spreadsheet for the withdrawal rate, or just engage in a conversation. So
I have a question.
sure.
Coming back to annuities, is it possible for annuities to run out of money completely so that your balance goes to zero?
So good question. The annuity is guaranteed by the company that issued it. So there's good news and bad news there. They're on the line. Whoever you bought it from, assuming it's a reputable company, and most of these are sold by large insurance companies, you're as safe as the company is. If the company continues to exist, they're going to pay you for the rest of your life. Okay. Now people say, well, that's not diversification. I say, no. The truth of the matter is that in the insurance business, these guys kind of look after each other. So if you bought an annuity from a company that had trouble, somebody's going to buy that company up probably and guarantee that deal. So I think annuities are relatively safe in terms of are you going to lose all your money? I don't think so. I mean, there's a possibility, but I don't know of any annuity companies that have gone out and left people high and dry.
And by
And there's lots of
company, by company, you mean insurance company that
right.
sells those?
Whoever issued. Okay, so I got annuities sold by XYZ insurance company. It's you're guaranteed as long as they're in business and can give it to you, but it's a highly regulated industry. I mean, I don't know of any defaults on annuities, quite frankly.
Thank you.
But they are guaranteeing it. They're standing behind their product.
But aren't annuities in general thought of an inferior investment product?
No, I don't think they're not a bad product. The question is good the worst enemy of the best? And so, I like to say, gosh, it would be better if people were educated and if they understand the stock market and they're not afraid of it, it will be your friend and you can get the returns. I mean, there's no reason to believe that an insurance company could get a higher return than you could as an individual, because you can buy these index funds and get market returns, and they're not going to do any better than that. We saw that in the presentation earlier. The pros don't do any better than the market or the index funds. So you're just giving up return in favor of a guarantee. It may make you feel better, but you're going to sacrifice returns because the company selling this annuity has to make a lot more on their money than they're paying you, or else they can't cover their costs and they can't make a profit, and they're not in business to lose money. Let's face it, and they pay very, very generous commissions to people who sell them. So they're not an inferior product. I don't want to say that. They're a good product, but I don't think.
I just meant in the way of return. You are not making I mean, they are, your returns are eaten up by all the fees and commissions because it's.
That's my point. That's my point. I'm sure there are good annuity contracts. The ones I've looked at, and again, I'm not an expert, but I've looked at a number of them. And I can say I would not have recommended anybody to buy them. And most of them have surrender charges through the first 8 or 10 years. So you're kind of stuck with them for a while. And that's part of the whole deal. I mean, there's some upfront costs to the insurance company to issue them and pay the commissions and so forth. So they don't want you buying an annuity and then bailing out the next year.
Are there
Other
any
questions?
benefits of having IRA versus Roth IRA?
The Roth IRA is a miracle on steroids. Now, if you do the mathematics, it doesn't really make any difference. The Roth IRA is more expensive because you're investing funds where you've already had to pay income tax on it. So you're paying the taxes up front, but the earnings on the Roth IRA continue to accumulate without taxation. And if you're taking it out later, or you're putting in your estate plan to give to an individual later, when you or that individual take the money out, it's already been taxed, so you don't pay any tax on it. And so in a regular IRA, where most of my money is, unfortunately, I didn't pay taxes on it when the money went in, but when I take it out, it's taxed at regular income earnings rates. So it's a real tax hit when you pull the money out. So, and most of the time when people finally get around to pulling money out of a Roth IRA, most of the money in there is money that was earned after you put it in. So the minor point that you actually put in that was taxed, all the earnings are not taxed, and when you take it out, it's not taxed. So if you own a Roth IRA for any period of time, all that accumulated income stays in there, is not taxed, and it isn't taxed when you take it out. So it's I wish I had more money in my Roth IRAs and less in my regular IRAs. But and again, my estate plan is that a certain amount of my estate would go to my children, and I'd like to have that be in the form of a Roth IRA, because then I could pass that on to them, and they wouldn't have to pay any income tax when they take it out. If I pass the regular IRA to them, it's fine, they get the money. But then when they take the money out, they're going to have to pay it on the income tax. They're going to have to pay income tax based on their income at that time. And there's lots of restrictions now on regular IRAs. Got to take it out in 10 years and that sort of thing.
So if you invest money pre-tax, then you only can put these investments when you get money out only to Roth, to regular IRA, right?
Right.
Because money is already, not taxed yet.
Yeah. Now you can always, a lot of people miss this. There are limitations for how much money you can put into a Roth IRA or a regular IRA every year. There is currently no limitation to how much money you can transfer from a regular IRA to a Roth IRA. Now, when you do that, the amount you transferred is going to be taxable income, and you will pay income taxes on it at that point in time. But there are situations where people look at that and say, gosh, I'd rather pay the income tax now because I know what the rate is, rather than later when I don't know and I think taxes are going to go up. So there are instances where that makes a lot of sense. But people say, well, I can only transfer so much over into a Roth IRA, and that's not true. You can do any amount if you want to. You just have to pay the tax on that amount transferred. And after that, then it's in a Roth, and it's not going to be taxed again. The government's already gotten its money. So I like Roth IRAs, I really do. I wish I had more money in them.
So you cannot pull money from IRA, pay tax, and put in Roth?
Yeah, you can. You can transfer any amount of money you want, but understand that that amount is going to be taxable income too when you pull it out of the regular IRA. And there may be instances, for instance, if you had I had one instance where I moved into a retirement community and they have a deal where the money you pay toward medical is a deduction. And I had a huge deduction, medical deduction when I moved in. And so I moved a bunch of money from the regular IRA to the Roth IRA. Theoretically, I paid income tax on that, but actually it just brought my income back to the point where I started paying income tax again because of this huge deduction. And so it was kind of a free interchange for me. And it was a golden opportunity to make that switch. So we took advantage of that. Then there are instances like that you could do. If you're in business and you take a loss in a given year, you can transfer some money to create some income. So you bring it back up to where you're paying taxes. So there's tax planning that can be done. That's one of the vehicles that you can use. But the more money you can get into a Roth IRA, assuming you or some other individual is going to take it out sometime, well, when it comes out, it's not taxed. That's a great benefit.
Thank you. Does anybody else have any questions?
All right, thanks.
Well, thank you very much.
Thank you.
Thank you. Thank you. We will post the video recording of this presentation on our programming blog for everybody to enjoy. Thank you very much, and everybody have a great day.